This is a BC Eagle Finance video, Brigham and Houston, Chapter 3, Learning Objective 7, Free Cash Flow. What appears on your screen is the free cash flow statement for the Allied Food Products Company that is part of your chapters. Now, what is free cash flow and how does it differ from the statement of cash flow? The cash flow statement that is in annual reports is an accounting convention and is designed to show where cash comes from in terms of operating activities, investing activities, and financing activities. And what the accounting statement does is to reconcile the change in cash that's on the balance sheet to net income. Many business owners find that information useful, and it makes a good distinction between why the cash change differs from what net income is. Free cash flow, on the other hand, is an adjustment to the cash flow statement to eliminate any effects of financing costs. Now, the reason why finance people like to do that is because it just shows the available cash after replacing equipment, keeping the productive capacity at its current level, the cash flow that's available for discretionary spending, specifically payment of dividends for the shareholders. That's important. Let me say that again. The purpose of cash flow, or free cash flow, is to show the after-tax cash flow that's available for shareholders for their dividend payments. Okay, so how is the free cash flow calculated? It comes from both the income statement and it comes from the balance. So here's how the statement goes. Your book shows a formula, and here it is at the top right-hand side of your screen, that free cash flow is equal to EBIT, earnings before interest and taxes, times 1 minus the tax rate. That gives you something called NOPAT, net operating profit after tax. And if you would add the depreciation to that, you would have the net operating cash flow after tax. Remember that depreciation is a non-cash expense that decreases net income but has no effect on cash flow. That is why depreciation and amortization are added to NOPAT. Now, this would give you a measure of traditional cash flow. What free cash flow does is to go one step further by deducting the necessary capital expenditures that the business would make to maintain productive capacity. In other words, equipment wears out, and to be able to make as much as you did before, you have to replace equipment that's worn out. That's what this capital expenditure is for. And then there is another adjustment for the changes in net working capital. If net working capital goes up, that's a use of cash. If net working capital goes down, that is a source of cash. At any rate, comparing the after-tax NOPAT plus depreciation less necessary capital expenditures, that gives the business free cash flow. In this case, the Allied Food Products Company has a negative free cash flow of $109.7 million. Now, because it's negative is not necessarily bad. It just means that the company has focused on maintaining productive capacity and does not have any discretionary funds to pay dividends to the shareholders. And this is a typical observation that you would have with a company in its early growth stages that is using its available cash to expand into the productive assets that give it its core revenue. Okay, let's do some of the mechanics of this particular statement. The free cash flow begins with operating income, or EBIT. And then you can see in this case it's $283.8 million. Now, how would they get that? Well, if you would take the sales less the operating costs, except for depreciation and amortization, of $2,616,000, and then calculate the tax on that amount, so $283 $100,800 times a tax rate of 40% would give you tax of $113,500. The net operating profit after tax would be $170,300. Onto that amount, you would add depreciation and amortization of $1 million. That is a non-cash item. And then you would go to the balance sheet that you have in a previous table, or you could look right at the statement of cash flows and review the change in the current assets and current liabilities. So let's take these items one at a time. You see that cash has gone down by $70 million, and so that would be like a source of cash. Add it to the NOPAT amount. Inventory has decreased, so that would be a deduction. Inventory has increased, so that would be a use of cash, a deduction in cash flow. Accounts receivable has decreased. Accounts receivable has increased, and so that would be a use of cash, and so deduct the increase in accounts receivable. Wages payable has gone down by $10 million, and so that would be a source of cash, and accounts payable has gone down by $30 million, so that would be a source of cash. Adding the changes in working capital to the after-tax cash flow, you get after-tax operating cash flow of $120,300,000. Now, from the investing section of the cash flow statement, you can see the company purchased $230 million of equipment. That's to maintain productive capacity, so deducting the $230 million from the $120,300,000 of operating cash flow gives the negative cash flow of $109,700,000. And as we said, because of the necessity to grow the company and invest in new assets, this negative amount is not necessarily a bad thing. It just says that the company's operating position does not allow it to have discretionary cash available to pay to shareholders in the form of dividends. If you have any further questions on the content or the calculations of free cash flow, please start a Canvas discussion, and all of us, including myself, will respond to Canvas so that everyone knows what each other is thinking. Next up, the distinction between market value added and economic value added. Where we're headed is the calculation of this economic value added concept. Market value added, as you can see, is the market value of the owner's equity determined by the price per share that you can read in the Wall Street Journal or look up online, times the number of shares that the company has outstanding. That gives the market value of the owner's equity. Now, if we would compare that market value to the book value of owner's equity, which is the balance sheet value of owner's equity divided by the number of shares, you would get the book value per share, or what it costs the company to get the net assets that it has. So if we compare the value of those net assets determined by the stock price less the cost per share determined by what the company paid for the assets that are reported on the balance sheet, you would have this concept of market value added. That means that the company, organization, products, and market share has increased the value of its net assets to a higher amount than what it cost the company to buy those assets. Now, let's take a look at the concept of economic value added. Economic value added is another way to look at the income of the company. Now, let's see how this works. You would start with this concept of NOPAT, net operating profit after tax less, in fancy terms, a charge for the cost of capital. You'll remember from Chapter 2 that the income statement has one thing that finance types would like to adjust, and that is the income statement only shows one cost of financing, and that's the cost of interest. The income statement does not show the cost of equity capital, which is determined by dividends. And so the income statement really understates the cost of financing from all sources. What the economic value added measures is the NOPAT, net operating profit after tax, less the cost of financing from all sources: debt capital, contributed capital, and earned capital. Okay, so how does it do that? Well, we have this neat little lady here, EVA, economic value added, which is calculated by the NOPAT, and the cost of capital is equal to the total invested capital for the business, and essentially that is the sum of all long-term financing, debt capital, contributed capital, and equity capital, times the percentage cost of capital. That's the weighted average cost of all sources of financing. For this chapter, we will just state what this weighted average cost of capital is. In Chapter 12, we will spend a little bit of time detailing how this cost of capital is calculated. But for the time being, the takeaway from economic value added is that it's the net income or value added for shareholders calculated by taking the net after-tax operating profit less a charge for all sources of financing: debt financing, stock financing, and retained earnings financing. Retained earnings financing may also be known as internally generated funds. So here is an example of how to calculate market value added. This is from problem 3.6 at the end of the chapter. So here you have the Masterson Corporation that has provided $34 million of capital when they purchased new issues of stock and allowed management to retain some of the earnings. The firm now has 2 million shares of common stock outstanding, and the shares sell for a price of $28. The question is, how much value has Masterson's management added to shareholder wealth over the years? That is, what is Masterson's market value added? So in this case, we want to see how much more value the market has added to the cost of the net assets that Masterson Company has purchased. In this case, we would take the total assets less the total liabilities. Now, for this problem, that information wasn't given to you, so I'm showing you them here in the form of X's, but they did give you the shareholders' equity. That would be the common stock and retained earnings of $34 million. In some of the other problems, you may not get the owner's equity directly, but may need to calculate it by taking total assets less total liabilities. Now, if we take the retained earnings plus common stock, $34 million, and divide it by the 2 million shares outstanding, we have the market price per share. The market price per share times 2 million gives $56 million as the market value of owner's equity. Compare that to the $34 million that represents the cost of the owner's equity, 56 minus 34, that gives you market value added of $22 million. So, in answer to the question, how much has management added to the value of the assets that were purchased by Masterson Company? The answer is $22 million. Now, let's take a look at the concept of economic value added. Economic value added is another measure of income or an increase in shareholders' wealth as a result of running the business. So let's take a look at problem 311 from the back of your chapter. For 2016, Gourmet Kitchen Products reported $22 million of sales and $19 million of operating costs, including depreciation. The company has $15 million total invested capital, and its after-tax cost of capital is 10%. Its federal plus state income tax rate was 36%. What we want to do is to calculate the firm's economic value added, EVA. That is, how much value did management add to shareholders' wealth in 2016? This is an income statement approach to an increase in wealth. Let's see how it's done. We would create a traditional income statement by starting with sales, $22 million, and deducting the operating expenses as well as depreciation, which total $19 million. That gives you a pre-tax operating income of $3 million, and if the tax rate is 36%, 36% of $3 million produces a tax rate of $1,080,000 and an after-tax income of $1,920,000. Now, we want to add or deduct a charge for financing costs. It's called a capital charge. So let's do some more calculating. This problem gives you the total invested capital as $15 million, but we know that invested capital would be the sum of all long-term financing sources. So if you want to determine how this $15 million was calculated, you would take the total of long-term debt plus stock plus retained earnings. Those three together would give invested capital of $15 million. The cost of that $15 million of capital is 10%, so 10% of $15 million produces a capital charge or a cost for all sources of financing of $1.5 million. Net income, NOPAT, after tax was $1.9 million, less the capital charge of $1.5 million. That produces an economic value added, an amount of value added over the cost of financing of $420,000. So there you have it, the concept of economic value added. Now, a little bit more on taxes. The tax rates that you have in your textbook for Chapter 3 are outdated as of December 2017. You know that in that month, the Congress passed the Tax Cut and Job Act on December 22nd, 2017, and radically changed the tax rates for businesses as well as individuals. This section reviews some of those items. So here are the tax rates for individuals for 2018. The tax code has different rates for different marital status. So for unmarried individuals, these are the rates that they would be subject to. For married individuals, these are the tax rates that they would be subject to. And finally, for heads of household, whether it be a one-parent family, for example, these are the tax brackets and rates that these individuals would be subject to. Also, the standard deduction has been significantly increased. And the personal exemption, which has been part of the tax code up through the end of 2017, has been eliminated. Beginning with years after 2017, there will be no personal exemption on the tax return. Single individuals receive $12,000 standard deduction, married, double that, and head of household would have 150% of the single person's standard deduction. So there is a quick summary of the Tax Cut and Jobs Act of 2017. On the corporate side of income tax, it has been made tremendously easy. Up until the end of 2017, corporate income was taxed on a graduated system similar to what you saw for individuals. As of January 1, 2018, for corporations, all corporate tax will be taxed at a flat 21%. This is good news for corporate America. Also, the Tax Cut and Jobs Act repealed something called the AMT, Alternative Minimum Tax, up until the end of 2017 to make sure that corporations paid at least some income tax. There were some calculations that were necessary to eliminate some of the favorable deductions. Those calculations are now eliminated. There is no AMT, Alternative Minimum Tax, for corporations. Now let's take a look at one other topic, the income that a company would have when it finances assets through debt versus the income the company would have if it financed assets through equity or stock. It can be significant. So let's take a look at an example that's in the textbook. Let's suppose a company had $5 million in sales. It had operating costs, including depreciation, of $3.5 million, and that would give the company EBIT, earnings before interest and taxes, of $1.5 million. And let's say that the company, from the debt that it has $1.5 million of interest. The $1.5 million of interest would completely consume all income before interest and taxes, so that the income before tax would be zero. Applying a 40% tax rate on zero would give zero income, so the income after tax available to investors would be zero. And therefore the rate of return on the $10 million of assets that this particular company has would also be zero. Not a real good deal. But let's see what would happen with a company that had the same income but financed instead through using stock instead of debt. So we have the same sales of $5 million less operating costs of $3.5 to produce $1.5 million of EBIT. Since dividends are not considered to be expenses in the generation of income, there would be no deduction for financing costs when equity is used. So the entire $1.5 million of EBIT would go to the company's bottom line net income of $1.5 million. Applying a 40% tax rate, you would get $600,000 of taxes. $600,000 from $1.5 million produces after-tax income of $900,000. That income would be available to the shareholders, and dividing $900,000 by the $10 million of assets produces a rate of return to investors of 9%, a significant difference from zero. So companies pay close attention to whether financing should be done through debt or equity, and what the effect of each would have on net income. One final item on taxes. We know that companies operate in business cycles. Some years or series of years do very well, and then there might be a loss. And Congress recognized that in those loss periods, well, they don't pay any taxes. If you don't have income, you don't pay taxes. But in the years that the company does have income, well, they pay taxes. Big accounting firms and big businesses some years ago lobbied Congress to get something called loss carryback and loss carry forwards into the tax code. That means that if there is a loss in one year, they can take the value of that loss and apply it to past year's income to get a tax refund. It offsets income that was earned in the past on which taxes would be paid, and those taxes could be refunded in the year of the loss. And if past year's income was insufficient to cover the net operating loss, businesses could carry forward that loss until it is completely consumed. The Tax Cut and Jobs Act of 2017 completely eliminated any carrybacks, which means that corporations can't get tax refunds beginning in 2018. They can only apply the net operating loss against future years' income. But the good news is there is no stale date on the carry forward. The carry forward can happen indefinitely until the net operating loss is entirely consumed by future years' income. Let's take a look at an example. Let's say that the original taxable income was $2 million and the corporation had a tax carryback of $4 million in 2016. So up until the year 2017, a net operating loss could be carried back against income of the prior 2 years. So with a $4 million net operating loss, $2 million of it could be used to offset 2014 income, and the remaining $2 million could be used to offset 2015 net income, so that the adjusted taxable income for these 2 years would be zero. Previously, the company would have paid 40% tax on $2 million of income, or $800,000 in each of these years. Because the net operating loss carryback caused restated income for both years to be zero, both the 2014 tax payment of $800,000 and the 2015 tax payment of $800,000 would be refunded to the corporation in 2016. So, as a recap, $4 million of the net NOL in 2016 could be carried back to previous years. If the net operating loss was $12 million, that means there would still be $8 million to carry forward in a similar way to offset income in future years. So until the company has future income of $8 million, this company would pay no taxes. And that's good news. This is the end of Chapter 3. Thank you for listening.